Okay, we continue here with video 4 for chapter 10 homework, picking up with our transactions and recording those in our accounting framework. So our 11th transaction, we paid $71,000 for inventory holding expenses for completed ebook readers. This is rent in a warehouse, salaries of warehouse personnel. So what we're thinking about here is that we're downstream. We're no longer in the midstream section. We've moved downstream where we're talking about our distribution, our warehousing, our finished goods. We're not making the ebook readers anymore. So we're in our downstream cost segment. So for transaction 11, we paid an expense, we paid an item, so we're going to reduce our cash for sure. But we're not going to work in process anymore because that's midstream costs. We're moving back over to our retained earnings because we're out of the midstream and we're actually downstream at this point. So our retained earnings is going to be reduced for that expense. And again, our cash is going down, and we're talking about folks that we deal with every day, storing those that finished goods. That's going to be an operating expense. That's going to be an operating activity. Okay, so transaction 12, completed and transferred ebook readers that had a cost of $260 from work in process. From work in process to finished goods. That's it. As long as we can type in the right amount. Okay. These two items net to zero. Our accounting equation is good to go. Was cash impacted? No. Not applicable. Oh, we missed one here. $52,000 cash payment. This was for our rent and utilities expense, our cost. So somebody that we deal with every day, a vendor, a supplier. Okay, very good. Number 13 then. Sold 950 ebook readers for $423,000. It doesn't say on account or cash, so we're going to assume that we're good to go with cash. $423,000. Let's see. Our cash is going up. What else do we have here? Yes, we have sales. We have revenue. So our retained earnings, our earnings are going up. Our profit is going up because of that sale of those items. And now for the first time in our framework here, we have revenue. We also have an increase in our cash flow. That $423,000 is going to increase our cash, so it's cash provided. Again, operating activity, our customers, it's something that hopefully we deal with every day, part of our operating activities. Then item 14 tells us that those costs of those items that we sold was $161,500. So the cost of those items was $161,500. Was cash impacted? No, not in this particular transaction. What we're showing is that the finished goods are no longer ours, so we're going to reduce our finished goods inventory, and we're going to reflect that in our retained earnings account, the cost of those items that we sold. Okay, that's going to be an expense for our income statement of $161,500. Okay, cash was not impacted because we didn't pay for those items. We've recorded the costs up here as we built those ebook readers. So here in that last transaction, we're just simply showing our finished goods reducing and our expense, the cost of goods sold, having a negative impact on our retained earnings. Okay, so let's move on then to our schedule of cost of goods sold so we can better understand this $161,500. So we need to start off with our beginning raw materials. So for our beginning raw materials, we can go to our framework and see that we started with $62,000 in raw materials when we started this period, this year, this month. Okay. So then what did we actually have in purchases of additional materials? Well, here in our second transaction, we can see that we bought more raw materials inventory. Did we have any other purchases? No, we did not. So our purchases, we can just pull that $53,000 down. The total materials that we had available is going to be the 62,000 plus the 53. So during this month or during this year, whatever we happen to be working on here, we had $115,000 worth of materials that we had available to us. What did we end the period with? We ended with $31,000 in materials. That's our raw materials inventory ending balance. So what's that imply? That we had 115 available. We still have 31 available. So we used up or transferred into process that 84,000 that we see right here. Okay. Then we have our labor that got applied to our work in process. Let's see here, which item was that? Might be better served up here. Production wages, 106. So we had 106 in labor and overhead. So we've accounted for the materials, we've accounted for the labor. These last two items here were our two overhead items. We had our depreciation and our rent. So we can add those two items up, our depreciation and our rent, and see that we had $63,000 in total overhead. So our total manufacturing costs were the materials that we used, plus our labor, plus our overhead, for a grand total of $253,000 in manufacturing costs. Our beginning work in process balance from our framework was $37,000. So if we then subtract our ending work in process inventory, we can see that our cost of goods manufactured, the manufacturing costs plus what we began with in inventory, and subtract away the ending work in process inventory, we can see that the items that we actually worked on during this month or year was $260,000. Our beginning finished goods inventory was $43,000, and our ending finished goods inventory was $141,000. So we saw a big increase in our finished goods inventory during this period of time. So then our cost of goods sold for this period was the cost of goods manufactured plus our beginning inventory, subtract out the ending inventory. There's our $161,500 that the book gave us, but now we have a better understanding of its parts and pieces and how that was actually comprised and arrived at. Okay, very good. Let's move on to our income statement then. Let's look back to our framework so that we can start to populate in our income statement. What did we have in sales? What did we have in revenue? Let's go back to our framework, and here's our revenue column. $423,000 was our revenue for this period of time. Let's format this so we can actually see the numbers. There we go. Our cost of goods sold for the period, well, we've calculated this here in this schedule. We also see it here in our framework. Either way, the $161,500 is our cost of goods sold. our gross margin is simply just our sales minus our cost of goods sold. So for this particular problem, it's going to be $261,500. So again, our revenue or our sales minus our cost of goods sold. Our admin and selling expenses, what's our period costs? Well, we can go back to our framework and look at our total expenses and just simply subtract off our cost of goods sold. These other items in here are all other operating expenses, period costs that we had during the month. We could add those up if we wanted to, or just simply do the subtraction, either way. And we're coming to $184,000 in operating expenses. So then our final step in looking at our income statement then is to just simply subtract off those operating expenses from our gross margin. So our gross margin minus those operating expenses gives us a net income of $77,500. Okay, very good. Let's take a look then at our balance sheet. Our balance sheet really comes together pretty easily. All we need to do is go back to our framework and just pull these ending balances that we calculated for each of our different accounts. So as we look at our cash account, we have an ending balance of $410,000. Let's again, sorry about the formatting here. Let's get those formatted as numbers so that we can read them. Our raw materials inventory, $31,000. Next door to that is our work in process. Next door to that is our finished goods. Next door to that is our manufacturing equipment. No, our manufacturing equipment's there. And our office equipment is here. So that gives us a total asset number of $886,500. And do we have any liabilities? We have no liabilities. So let's move on to our common stock, our equity section. So our common stock ending balance, $597,000, and our retained earnings ending balance, $289,000. And lo and behold, our total assets agrees to our total liabilities in equity. Again, I know I'm kind of moving at a quick pace here on the video. That's just so we can get through the material and get through the content here. Please do feel free to rewind, pause, email me with questions if I move too quickly on anything here. But again, just trying to give you a good work aid and tool to complete any of these and kind of make the connections so that in class next week we can move forward into chapter 11. So the fourth word for your email, the fourth item that you'll need for your keyword string is 2. The fourth word for your email string is the word 2.